March 2023. Silicon Valley Bank collapses. Signature Bank collapses. First Republic teeters. Depositors panic. Lines form at banks. Government announces all deposits protected. Crisis averted. Everyone relaxes. But buried in the announcement, one word changes everything. Systemic risk exception. Not FDIC insurance. Not standard protection. Exception, meaning they broke their own rules. Because FDIC insurance covers $250,000, SVB had deposits over $175 billion, most accounts over the limit. They paid anyway, this time, but the rules say something different, something most people never read. In a crisis, banks can take your deposits, convert them to equity, make you a shareholder. In a failing bank, this is called bail-in, and it's legal. Welcome to Financial Rewind. I'm here to expose what's hidden in the fine print. And today, we're revealing the bail-in trap. How Dodd-Frank authorized banks to use your deposits as capital. How FDIC has $250,000 per account but only 1.3% reserves. How Cyprus 2013 confiscated 47% of deposits over 100,000 euros. And why U.S. banks have the same legal authority. This is the emergency power, written into law, waiting to be used when the next crisis hits. Let's start with what FDIC insurance actually is. Because most people misunderstand, Federal Deposit Insurance Corporation, created 1933, after bank runs destroyed savings during Great Depression. Purpose: prevent bank runs, guarantee deposits, up to $250,000 per account, per bank, per ownership category. How it works: banks pay premiums into FDIC fund, currently 0.13% of deposits annually. Fund accumulates over time. When bank fails, FDIC pays depositors up to limit. From the fund, this is insurance model. Seems safe. Until you look at numbers. Total bank deposits in U.S. $18 trillion. FDIC fund balance. $128 billion. That's 0.7%. Less than 1% coverage. For every $100 deposited, FDIC has 70 cents. To cover failures, now do the math. If 5% of deposits flee, that's $900 billion. FDIC fund, $128 billion. Cannot cover it. Not even close. Fund runs out immediately. This is the first problem. FDIC is underfunded. Massively. Here's what happened in 2008. To see the pattern, 25 banks failed in 2008. 140 banks failed in 2009. 157 banks in 2010. Total from 2008 to 2012, 465 banks. Total deposits, $650 billion. FDIC paid out. Using fund balance, borrowing from Treasury, selling failed bank assets. Cost to fund, $37 billion. Fund balance dropped from $52 billion to negative $21 billion. Negative. The insurance fund went broke. Had to borrow from Treasury, rebuild over next 5 years, through special assessments on banks. It worked. Crisis was contained. But here's the key. 2008 crisis was mostly big banks. Lehman, Bear Stearns, Merrill, Wachovia. FDIC didn't cover those. Federal Reserve did, through emergency lending, through arranged mergers, through bailouts. If FDIC had covered big banks too, fund would have needed trillions, not billions. Would have collapsed completely. So they learned, can't rely on FDIC fund for systemic crisis. Need different mechanism. Enter bail-in. Let me show you Cyprus 2013, because this is the template. March 2013. Cyprus banking system collapses. Two largest banks insolvent. Bank of Cyprus, Laiki Bank, combined deposits, 30 billion euros. Country GDP, 17 billion. Banks bigger than entire economy. Crisis hits. Banks exposed to Greek debt. Greece defaults. Cyprus banks take massive losses. Insolvent. Need bailout. Cyprus asks EU for help. 10 billion euros needed. EU says, we'll give 5 billion. You must raise 5 billion internally. How? Bail-in, the 25th of March 2013. Cyprus announces, all deposits over 100,000 euros will be converted to bank equity, confiscated to recapitalize banks. Bank of Cyprus. Deposits over 100,000 euros. 47.5% confiscated. Not insured, not protected, just taken. Overnight, depositor with 200,000 euros wakes up with 105,000, 95,000 gone. Now owns worthless shares. In failed bank, Laiki Bank worse. Completely liquidated. All uninsured deposits. 100% loss. Wiped out. This happened in European Union, modern banking system, democratic country, not Venezuela, not Zimbabwe, Cyprus, EU member state. And it was legal, pre-authorized, by banking regulations, implemented overnight. No vote, no warning, just done. Now here's the U, S, legal framework. Because same authority exists here, Dodd-Frank Act, passed 2010. After 2008 crisis, Title II, Orderly Liquidation Authority, gives FDIC power to resolve systemically important banks without taxpayer bailout. How Section 210, FDIC can take over failing bank, convert deposits to equity, impose losses on creditors, including depositors, over insurance limit. This is bail-in authority, written into law, explicit, clear, legal. Now, they say, this only applies to big banks, systemically important, not your local bank. Okay, but what's systemically important? Banks over $50 billion in assets. 33 banks qualify. JP Morgan, $3.7 trillion. Bank of America, $3.2 trillion. Wells Fargo, $1.9 trillion. Citigroup, $2.4 trillion. These four alone, $11 trillion in assets, $7 trillion in deposits, all subject to bail-in authority. If they fail, your deposits over $250,000 can be converted to equity, legally, overnight, just like Cyprus. Let me show you the legal language. Direct quote from Dodd-Frank, Section 210A, 1D. The corporation may take such action as the corporation determines is necessary or appropriate to facilitate the orderly liquidation of the covered financial company. Section 210B4. The corporation may provide for the payment of obligations that the corporation determines to be necessary and appropriate to facilitate the orderly liquidation of the covered financial company. Translation. FDIC decides what's necessary and appropriate can take your deposits if they determine it's needed for orderly liquidation. No congressional approval, no court order. FDIC decision. Final, immediate, legal. Now here's Section 210H5E. The key clause. Any deposit delivered under this paragraph shall not be available to any person claiming such deposit. Once converted, your deposit is gone, not available. Legally, you own shares instead. In failing bank, worth pennies, or nothing. This is the law, past 2010. Sitting there, waiting for next crisis. Here's how it would work in practice. Bank of America fails. $3 trillion in assets, $2 trillion in deposits, $100 billion in capital. Assets lose 20% value, $600 billion loss. Bank insolvent, capital wiped out, needs recapitalization. FDIC takes over, invokes orderly liquidation authority, announces bail-in, deposits under $250,000, protected. Those total $300 billion. FDIC covers with insurance fund. Fund has $128 billion. Borrows rest from Treasury. Deposits over $250,000, $1.7 trillion. Converted to equity. New shares issued. You owned deposit of $500,000. $250,000 protected. $250,000 converted. You now own shares. In restructured Bank of America, market immediately values these at 30%. Your $250,000 now worth $75,000. Total $325,000. Lost $175,000. Overnight. No vote. No appeal. Legal. This is the mechanism. Built into law. Ready to deploy. Now let's talk about SVB March 2023, because they almost used it. Silicon Valley Bank, $212 billion in assets, $175 billion in deposits, mostly over insurance limit. Tech startups, venture capital, cash management accounts, multi-million-dollar balances. Bank fails March 10, deposits frozen. Panic spreads. Signature Bank fails March 12. First Republic teetering. Runs beginning at other banks. System stress critical. March 12, government announces. All SVB depositors protected, even over limit, using systemic risk exception. Special authority. Crisis averted. Deposits flow back. System stabilizes. But here's what they considered. Before making that decision, bail-in option was on table. FDIC had legal authority. Dodd-Frank explicitly allows it. SVB was perfect candidate. Over 50 billion assets. Systemically important. Could have converted uninsured deposits to equity. Made depositors, shareholders, in failed bank. Lost 70 to 80%. This was discussed. In emergency meetings, March 10 to 12. Decision made. Too risky politically. would cause broader panic. Tech sector would revolt. Congressional blowback. So they used exception instead. Taxpayer-backed guarantee. This time, but the authority exists. And next time, with bigger crisis. Multiple banks failing. FDIC fund depleted. Treasury reluctant. Congress hostile to bailouts. They will use bail-in because it's legal, and they have no other option. Here's the international framework. Because this is global policy. G20 meeting, 2011. Financial Stability Board created. International body. Banking regulators worldwide. Published framework, 2011. Key attributes of effective resolution regimes. Section 3.5. Resolution powers should include bail-in. Explicit recommendation. All G20 countries should implement bail-in authority. For failing banks, who implemented? European Union Bank Recovery and Resolution Directive, 2014. United Kingdom Banking Act, 2009, amended 2014. Canada Budget Implementation Act, 2013. Australia Financial Sector Legislation Amendment, 2018. New Zealand Open Bank Resolution Policy, 2011. United States Dodd-Frank, 2010. All major economies have bail-in authority, legal, ready, waiting. Cyprus 2013 was test case. Worked. Depositors couldn't stop it. Courts upheld it. System survived. Template proven. Now it's standard policy. Worldwide, your deposits are no longer deposits. They're unsecured credit to the bank, subject to bail-in, in crisis, legally. Let me show you the warning signs. From actual FDIC documents, FDIC Resolution Handbook, published 2014. Chapter on Orderly Liquidation Authority, page 37. Quote, creditors of the covered financial company may be subject to losses. Footnote defines creditors, including depositors. Explicit, right there. In official handbook, FDIC deposit insurance frequently asked questions. Question, are all deposits insured? Answer, FDIC insurance covers up to $250,000 per depositor, per insured bank, per ownership category. Then, deposits exceeding insurance limits may be at risk in the event of bank failure. At risk, official FDIC language, meaning can be lost. Legally, bank account terms and conditions, that nobody reads. Page 47, section on deposits during insolvency. Quote, in the event of insolvency, deposits may be converted to equity or subject to loss as determined by regulatory authorities. Buried, dense legalese, but explicit. You agreed to this. When you opened account, clicked I agree, never read it. Nobody does. But it's there. Legal authorization. For bail-in, you consented unknowingly, irrevocably. Here's what happened in other countries. Recent examples. Spain, 2012 to 2013. 4 regional banks nationalized. Bankia largest. Uninsured deposits converted to equity. Shareholders and bondholders lost 90%. Some depositors lost 60%. Legal, under EU resolution framework. Italy, 2015. 4 small banks resolved. Depositors over 100,000 euros converted to shares. Lost 80% immediately. Protests followed. Government eventually compensated some. But legally, bail-in was valid. Portugal, 2014. Banco Espirito Santo, 78 billion assets. Resolved using bail-in. Large depositors. Converted to equity, lost 40%. Legal, under EU directive. Greece, 2013 to 2015. Capital controls implemented. Banks closed. Withdrawals limited to 60 euros daily. For months, large deposits frozen. No formal bail-in, but effective confiscation through liquidity restrictions. Legal, emergency powers. The precedents exist. Multiple countries, multiple methods, all legal, all implemented, all survived court challenges. The template works. And you, S, has same laws, same authority, same framework, waiting. Now, let's talk about what triggers this. Because timing matters. Small bank failures. FDIC handles normally, using insurance fund. No bail-in needed. Like 2008 to 2012, 465 small banks. All resolved. Depositors protected. System worked. Medium bank failures, like SVB. Government uses exception. Taxpayer backing. Prevents panic. Kickskin down road. No bail-in. Yet, but systemic crisis. Multiple large banks failing. Simultaneously, FDIC fund depleted. Treasury limit reached. Congress refuses bailout. That's when bail-in triggers. Because no other option. Can't let banks fail. System collapse. Can't use taxpayer money. Political suicide. Can't print money. Inflation already high. Only option left. Bail-in. Take depositor money. Recapitalize banks. Save system. Impose losses on creditors. Legal. Pre-authorized. Inevitable. Here's the 2024 setup. Commercial real estate crisis brewing. Office buildings, 40% vacant. Values down 30 to 50%. 2.7 trillion in CRE loans. 1.4 trillion maturing by 2027. Regional banks hold most. Exposed. Cannot refinance at current values. Losses mounting. New York Community Bank. 78 billion assets. Announced 1 billion CRE loss. January 2024. Stock crash 70%. Deposit flight. Forced to raise capital. This is one bank. 50 more have similar exposure. As CRE losses materialize, banks deplete capital, approach insolvency. FDIC fund covers small failures, but if 10 banks fail, each with 50 to 100 billion. Total, 500 billion to 1 trillion. FDIC fund, 128 billion. Cannot cover, not even close. Must use bail-in on largest accounts. To preserve system, legal, necessary, inevitable. Timeline, 2025 to 2027. As CRE matures, as losses crystallize, as banks fail, the bail-in authority will be used. First time in US, but not the last. Let me show you who gets hit. Because it's not equal. Accounts under 250,000, protected by FDIC insurance. Middle-class depositors, safe. Mostly, unless fund runs out, accounts over 250,000, subject to bail-in. Small businesses, cash management accounts, operating capital, payroll funds, all at risk. Corporations, treasury departments, millions in deposits. Working capital, all subject to conversion. High net worth individuals, multiple accounts, spread across banks. Each over limit, all at risk. Retirees, sold house, holding cash, 500,000 in bank. Before investing, half at risk. This is who loses. In bail-in, not billionaires. They don't hold cash in banks. Assets and securities, real estate, offshore, protected, small depositors protected. By insurance, middle tier destroyed, business owners, professionals, retirees, anyone with 250,000 to 5 million. In bank accounts, subject to bail-in, 50 to 70% losses, overnight, legal, this is the target. Upper middle class, successful small business, professional class. Wealth transfer, from productive class to banking system, to preserve system, at their expense. Here's what you can do, because some protection exists. Spread deposits across banks, 250,000 per bank, per ownership category. Stays under limit, fully insured, but requires multiple accounts. Administrative burden, use different ownership categories. Individual account, 250,000. Joint account, 250,000. IRA, 250,000. Trust, 250,000. Multiply coverage at same bank. But complex, requires planning. Consider credit unions, separate insurance fund, NCUA instead of FDIC. Same 250,000 limit, but different fund, diversification. Use Treasury Direct. Buy Treasury bills directly from government, no bank intermediary, no bail-in risk, but no checking features, not liquid. Use money market funds, hold treasuries, not bank deposits. Outside bail-in authority, but not FDIC insured. Different risks. Hold physical cash, small amounts for emergencies, but inflation erodes value. Theft risk, impractical for large sums. The reality, no perfect solution. All options have trade-offs. System designed to capture deposits, channel into banks. Subject to bail-in, you can reduce exposure, cannot eliminate, while staying in financial system. Let me address the counter-argument. This will never happen in America. Too politically toxic. Would destroy confidence. Government would bail out instead. These seem reasonable. America isn't Cyprus. Isn't Greece. Isn't Italy. We have reserve currency. Can print money. Don't need bail-in. But consider, what if next crisis happens during inflation? Like now? Fed already printed trillions. 2008 to 2020. Inflation running hot. Print more. Inflation explodes. Dollar crashes. Worse than bank crisis. So they can't print. What if crisis happens? During government shutdown. Debt ceiling fight. Congress gridlocked. Can't authorize bailout. Treasury can't borrow. Must use existing authority. Bail-in pre-authorized. Requires no vote. What if crisis happens? During political upheaval. Populist anger. At bank bailouts. After 2008. After SVB. Public demands. No more bailouts. Let them fail. Make depositors pay. Politicians comply. Use bail-in. Legally authorized. Politically defensible. Not taxpayer money. Depositors knew the risk. Overinsurance limit. The conditions exist. For bail-in deployment, not today, but soon, 2025 to 2027, when multiple factors converge. CRE, crisis. Political gridlock. Inflation concerns. Public bailout fatigue. Altogether, make bail-in. The only option. Legal. Prepared. Ready. In 1933, FDR declared bank holiday. Closed all banks. 4 days. March 6 to March 10. People couldn't access deposits. No withdrawals. No payments. System frozen. Then, Emergency Banking Act. Passed March 9. Banks reopened, but only solvent ones. 5,000 banks. Never reopened. Deposits lost. No insurance yet. FDIC created later. That year, to prevent future losses. Worked for 90 years. Protected depositors. Built confidence. System stable, but now, system evolved. Banks too big. Deposits too large. FDIC too small. Cannot cover. Systemic failure. So, new mechanism. Bail-in. Legal. Ready. Waiting. We're approaching. Another 1,933 moment. But this time, instead of bank holiday, bail-in. Instead of lost deposits, converted deposits. Same result. Different name. Legal framework. Already in place. History doesn't repeat. It reveals, and right now revealing, that deposit insurance is an illusion. For large accounts, that FDIC fund is a fraction of what's needed. That bail-in authority is law, waiting to be used. Welcome to the bail-in trap, hiding inside your bank deposits. Written into Dodd-Frank Act 2010. Tested in Cyprus 2013. Implemented in multiple countries. Legal in United States. Coming to your bank 2025 to 2027, when next crisis hits and FDIC fund runs dry, your deposits, over 250,000, become equity in failing bank legally overnight. Without warning, this is the trap, and you're already in it.